rate of people joining us has slowed down enough. I think I'm comfortable getting our investment commentary started. I'm Carl Frank, president of A&I Financial Services. Thank you so much for joining us. Today's conversation is international investing. We've got a special guest from American Funds Capital Group. I think you're going to enjoy him. Before we get started, as you may have noticed, we are recording this. So in order to keep your privacy, we made it so that we can't see you and we cannot hear you. But you can still ask your questions. Use the chat menu. The chat menu on most versions of Zoom shows up at the bottom. You just hit the word chat and start typing. And then at the end of today's presentation, I'll read those questions off and we can ask our expert whatever might be on your mind. International investing is certainly fraught with peril today and also great investment opportunities. It's been all over the news. I am assured that you're going to enjoy today's presentation. Our speaker today is Roger Bianco. Now, Roger and I have known each other a long time. He's a senior vice president and wholesaler at Capital Group American Funds. He works here in Colorado. He has 24 years of experience and 15 years with Capital Group. Prior to joining Capital, he worked at Van Kampen. Roger holds a Bachelor of Science degree from Illinois State University. He holds a Certified Investment Management Analyst designation. That's not an easy test. It's a big deal. He enjoys reading, biking, and playing the drums. Roger is a 21-year resident of Colorado, and he's based in Colorado. So I'm really looking forward to hearing your commentary today, Roger. I know that you spent a summer in Russia. That's not exactly, Soviet Union, I should say. It's not exactly our topic today, but you're going to have a really interesting commentary today, both from personal experience as well as some great research that your very big investment company does. And so without further ado, I'm just going to hand it off to you. And thank you, Roger, for being here. We're really looking forward to it.
Great, Carl. I really appreciate you. And thank you all for taking the time. But yeah, it was the summer of a long time ago between undergraduate and graduate work, having finished a bachelor's degree and doing some graduate work that I spent in what was almost the Soviet Union, and we were 2 years away from the disillusionment of the Soviet Union. And it was, as we've watched all this Russian-Ukraine stuff unfold, it just has brought back a flood of memories and a flood of things that I learned while I was over there that I do think apply today, 20 some odd years ago. And so we'll chat about that a little bit, no doubt. But thought I'd start our time together with a couple of things. Number one is a hearty thank you. And just to say, really appreciate you all taking the time to jump on board with us today to learn. You know, you should all be commended for being here. You're not the average investor. And I draw that distinction because the average investor doesn't do well as investors who seek information and work with financial advisors. Multiple levels of research have shown that, and you all are doing both of those things. And so you're to be congratulated and commended for being here. To kick off the topic, what I want to do is just share with you a quick story. And it was just something that I grabbed right before actually we went online here. My daughter, for years, played a game called softball, which I like to call fast pitch because there's nothing soft about the ball that they play with. And if you've ever seen the Women's College World Series or the girls that kind of do that windmill motion when they pitch, that's what my daughter played. And she was a pitcher and she was pretty good. And one year we had an opportunity to go down to watch the Women's College World Series in Oklahoma City, Oklahoma. While I was there, I bought this hat. This hat says USA Softball. And it's a little bit of a source of wounded pride and consternation to when I grabbed this hat and turned it over and looked at the Made in China label right there. I thought to myself, we should be able to make something like this in the United States, certainly. But the truth of the matter is we don't as much as we once did. And that has implications for us all as investors. And so that's what we're really going to focus our time on here. What's happening in terms of things like this being made in China has really largely happened. International trade, global trade has happened throughout human history. One of the things that makes this time, and you'll see some things that will talk to this, but one of the one of the ideas that makes this time in history unique to all other times in history is that this international trade is happening on a larger scale. It's much easier for goods and services, and notably money, currencies, and the like, and transactions to go around the world. So it's happening faster. So it's larger, bigger, it's larger, easier, and faster international trade. And that's going to continue. Now that, as I said, has distinct investment implications. And so from an investment standpoint, what I thought I would do is just start off talking with you about something that a couple of concepts regarding investing internationally that might be helpful to you in the 21st century. The first is, and I don't know to what extent you all have been following this, so I'll just tell you that over the course of the better part of the last 20 years, the U.S. stock market has done better than the rest of the world. We still make that comparison. The U.S. stock market has done better than the rest of the world. And so it would be relatively easy to conclude that maybe we shouldn't be invested outside of the United States. Maybe that's a long-term trend that's going to continue. But let me share with you a couple of points that are very interesting and should probably be considered to round out the thinking on that notion. The first one is this, and that is that what we're showing you here is the amount of stocks in the U.S. and outside of the U.S. that are among the top 50 stocks in each of the last 10 years. So from 2010 all the way forward to 2019, in each of these years, the percentage is the amount of the top 50 stocks that were domiciled outside of the United States. The average being 3/4. So in other words, the bottom line statement here with this relatively confusing chart is that 3/4 of the top 50 performing stocks in each of the last 10 years through 2019 have been stocks of companies that are outside of the United States, even though the U.S. stock market has done better than the international stock market over this time. Very weird thing to think about. Those things seem like they're contradictory notions, but that is true. It is true that even though the U.S. stock market maybe has done better than international stocks, a lot of the best performing stocks in the world, in fact, are outside of the United States. And so if we're not invested outside the United States, we don't get the benefits of having those stocks in our portfolio. The other notion being but many investors, as they go from earning a paycheck to creating a paycheck, which is commonly known as retirement, I call it from going from earning a paycheck to creating a paycheck, are very concerned with income. The notion that when you wake up, the morning after you wake up from retirement, your income is zero. So you have to generate an income. And so what we looked at was how many companies inside the United States versus outside the United States pay a dividend income of 3% or higher. So let me pause there for a second. Dividends being, as many of you know, but I should probably just not assume, take a moment to explain it, a per share dollar amount that is paid to owners of a stock to entice them to buy a stock. So for example, if you have a stock that pays $10 a share in dividends and you own 10 shares, when they distribute their income, you take the $10 a share times the 10 shares you own, you're paid $100. And what we like to see, what all of us in this industry like to see, is the higher the dividend, so long as it's a good quality and sustainable dividend, the better for people who are heading into retirement. And as you can see, the amount of stocks that are outside of the United States that pay high dividend yields are 4 and 5 times that of what is inside the United States. In other words, it's probably more important for investors to have some of their investments outside the United States, if an appropriate amount, I would say, outside the United States, if they've retired, if they've gone from earning a paycheck to having to create a paycheck, because the better dividend yields, the higher income coming into a portfolio, more companies outside the U.S. pay those higher dividend yields than inside. So very interesting. There's this other notion that we have as to why people should invest outside the United States. And it really revolves around a 21st century concept that can be best illustrated by sharing with you a couple of examples. And what we call this in our fund company is we call this the new geography of investing. And the best way I can describe this to you is by sharing with you the tale of three companies. All three of these companies are technology companies. They're semiconductor companies. They make microchips. There's a huge ongoing demand and a massive backlog globally for microchips, because as technology innovates, and as we will talk about here in a little bit, we're seeing more and more technological innovation entering into the world, which will in many ways make our lives better. You need to have more microchips. And so we have this massive backlog of microchips. Three of the largest producers of microchips in the world are Broadcom, which is headquartered in California, ASML, which is a company that's headquartered in Northern Europe, and then Taiwan Semiconductor, which is a company obviously headquartered in Taiwan, just that little island off the coast of China. And here's what's interesting about this. You'll see that Broadcom, the company that sits in California, earns 67.4% of its revenue. It does 67.4% of its business in Asia. Broadcom, the California company, does 67.4% of its business in Asia. Taiwan Semiconductor earns nearly 2/3 of its business, 60% of its business in North America, halfway around the world. ASML is a company that earns 80.6% of its business also in Asia. So as you can see, all three of these companies earn very little. Broadcom earning $1.04 from the Americas, or only 18.7% of its business from its home country. ASML doesn't earn anything in Europe, and Taiwan Semiconductor only earns 8% of its revenue. Only 8% of its business comes from its home country. This notion that the home country is relevant is less true today than it ever was. And again, what we call this is this new geography of investing. It's a very 21st century thing, but it is not as important to know where a company sits anymore as it is important from an investment standpoint to know where the company earns. And those arrows flying across the world, and you have companies that are literally doing most of their business halfway on the other side of the world, that's on the dark side of the world, if it's light side in your native area. And so this is the new geography of investing, and all this must be factored in. In other words, if you have a portfolio of largely U.S. companies, you still have international exposure. Over the course of the last probably 10, 15 years, between 40% and 2/3 of the earnings of the 500 companies that are listed in the Standard & Poor's 500 index, which is the market as sometimes it is reported to us, between 40 and 66% of their revenue has come from business done outside the U.S. So it's really virtually impossible for us to completely avoid international exposure, so to speak, if we factor in where the companies that sit in their home country earn, which are largely outside of the United States. And so it's a remarkable thing. It's a very interesting thing. It's a concept that is becoming, as I said, more true today, largely because global trade and global business is bigger, much more voluminous today than it ever has been. It's much easier to conduct, and money and transactions can be done in a much faster way. And so this concept is nothing that's going to be derailed, largely regardless of what political positions politicians take, so on and so forth. This is business having very few, if any, borders in the 21st century. And so all this we have to factor into the way that we think about investing, and it is largely part of your portfolio. And so we're a global research firm. Capital Group American Funds is a global research firm. And what we do is we go all around the world to try to find the best companies. And I figured I'd take some time to shed some light on what it is that we are seeing globally. What I mentioned earlier, that there's going to be some technological innovations that are going to make our lives potentially better moving forward, largely better moving forward. And so I figured I'd share you a quick story about where some of this information comes from. We, in the mid-1990s, went to our portfolio managers and analysts, and we asked them a straightforward question, which is, by the mid-2000s, so say by 2005, what's the world going to be like? What kind of technological innovation are companies spending money to develop, and what are they likely to bring to the market? And more to the point, what is that likely to do for us and the way we live? And so one of our portfolio managers at the time said, it is likely that by the mid-2000s, so by 2005, 2010, an entire wall of your home will be a television, which you can react to or you can interact with. Now, the entire wall he missed by, like one room over, I have a television that, it could be considered just about the entire wall. It's the place where we like to watch our football games and our baseball games. And my wife's a big tennis player, so it's the place we like to watch our tennis matches. And I can react to it. I can pick up the remote control. I can interact. I can talk to it, and off it goes. It'll give me what I want to see just by asking for it. So good prediction, not too far off. Another manager made the point. She said, you're probably going to have in the palm of your hand an entire personal computer, the computing power of an entire personal computer. And that is something that I'm sure most of us, if not all of us, have, which is a smartphone. So she was pretty dead on in that prediction that we will have we already have those things, and that we'll have more of those things moving forward. So we recently did this again. A couple of years ago, we asked our portfolio managers, okay, what is it that you see companies spending money on? What technologies are they developing? What's likely to be implemented by 2030 or before, as you'll see here in a sec, and how's that likely to change our world? And so we came up with these kind of 10 predictions. Now, again, none of this is prophetic, mind you. None of this is us being soothsayers looking into a crystal ball. This is simply what companies are spending money on and what they're planning to bring to market, and how this is going to help us become better in many ways. And so what do we mean? This fourth one here is this remote patient monitoring devices. And to introduce this for you, what I'm going to do is tell you a quick story. Well, I'll tell you the story. I'm going to turn on my overhead light because the clouds just went down and it got very dark. That hopefully is better. Last May, actually May of 2021, I was we had a daughter who played softball. We have a son that plays baseball too, and so I was coaching the baseball team. I was standing at first base and at a tournament of his, coaching first base, and I get a call from my wife, and she says, "Roger, I have COVID. You have to come home." So, long story short, she isolated herself for 10 days. She had a very mild case. We were blessed with that. In fact, on one of my multiple times I checked in on her. It was, I think, day 8. She was in there doing Pilates with her Pilates instructor on her laptop computer. So we had a good round with COVID. Not everyone is so lucky, but we didn't go to the hospital during that entire time. And the reason why is because we had a blood oxygen monitor that I picked up at the Walgreens a mile and a half away from my home. And we knew that if her blood oxygen level got into the low 90s, okay, that's an issue. We got to head to the hospital. Never got below 98. Luckily, my wife's a very healthy young woman. So it didn't get below 98. We didn't go to the hospital. We didn't clog up emergency rooms. We didn't unnecessarily take the time of doctors. It freed the world up for other people with more severe responses to COVID to get the treatment that they needed, to get what they needed done. And we didn't obstruct that. That was a great example of more that is coming. And in fact, it's not just, as you can see here on this chart, it's not just COVID. That's an area where this home remote patient monitoring trend had a positive effect. We'll see more of this in the field of cancer, cardiovascular disease, monitoring and doing something about diabetes, obviously sleep disorder, weight management and fitness monitoring is going to be a gigantic thing because there's a huge trend towards preventative medicine that is helping people stay healthy rather than addressing issues when they're not healthy. And then a big chunk that we threw in other conditions. So there's hardly going to be an illness or an ailment that we will get as we age that won't be at least partially treatable without us leaving our home. And you can see that the amount of money that's being spent on this globally to develop these technologies and develop monitoring devices and ways to deliver treatments is growing by about a 20% clip per year. Very significant. Perhaps my favorite story here that we're seeing globally, and you can see, by the way, that this is being spent by the United States and China are both leading the way there. Got to be able to invest internationally to take advantage of that. Another thing that's happening where the U.S. and China are leading is, this is very exciting, this notion of a cure for some kinds of cancers. Not just enhanced treatments, but cures. So what do we mean by that? Well, and for those of you who are medical professionals, I apologize. I'm going to butcher this technology. I'm not a doctor. I don't play one on TV. I'm not playing one now. But I will tell you that the way it was described to me is that cancer cells metastasize and duplicate themselves and grow in the human body because they mask themselves. This is a cancer cell, it has a mask over it where the body's normal disease-fighting cells just go right past it in the bloodstream, not recognizing that this is a cell that is bad for us. And so what this technology does, I believe it's called CRISPR technology, what it does, there's a number of companies around the world, US, Europe, and in China, that have worked on and are perfecting this technology where you can pull the disease-fighting cells out of the body. I believe they're called T cells. Don't quote me on that. Manipulate it in some way, put it back into the bloodstream so that it lifts the veil on the cancer cell, which means the body's disease-fighting cell won't go by. It'll stop, recognize the cancer cell for the harmful cell that it is, attack it, and rid the body of it. Remarkable technological advances where money is being spent globally at a rapid rate to try to make this implementable as soon as humanly possible. Really, truthfully remarkable. Digital payments, where people use their cell phones, Venmo and eBay and, you name it, electronic transfer of payments with Apple Pay, so on and so forth. This trend seems to be one that is bucking economic trends. We've had economic slowdown this year, could have economic slowdown next year, but watch what happens to the amount of money that is being spent electronically and digitally in the world since 2019. So from 2019, you see North America paid $180 billion in digital transactions. The rest of the world, $74 billion. Europe, $216 billion. And Asia and the Pacific region, $258 billion. Now, what you can see is from 2019 to 2020, so right before, or including the pandemic year, all those dollar amounts went up. 2021, not a great, also a pandemic year. We were maybe starting to emerge from that. But again, all those dollar amounts went up. 2022, global economic consternation, slowdown, lots of geopolitical shifts, as Carl alluded to. And, fears of recession, a lot of inflation hitting us first time in over 40 years. Digital payments are going to go up. 2023, even if we have recession, digital payments are going to go up. And so people are going to continue to spend more and more globally, digitally, using their devices as opposed to cash. And it was really very interesting. From October of last year to this weekend, my brother-in-law, we were on vacation with him. He gave me a $100 bill to pay for a couple of the meals that I fronted the money for him and his family, and a few of the meals actually. But he gave me this $100 bill, and I finally broke that $100 bill last Friday in downtown Denver. We don't use cash as much anymore, right? Not as many people do. And so this is a trend that we see continuing going forward. Another kind of neat thing that we see going forward, and I'll tell you this story by sharing with you, and I don't know how many of you saw the old movie from the late 1980s. called A Hitchhiker's Guide to the Galaxy. You can YouTube just about anything these days, but I'd encourage you maybe to YouTube A Hitchhiker's Guide to the Galaxy, the Babelfish scene. The Babelfish scene in Hitchhiker's Guide to the Galaxy. And so let me just explain this real quick. That the movie was a BBC, British kind of cult flick. I remember seeing it when I was a kid. And the notion was that it was these two average Joes, and their responsibility was to save the universe, the unsuspecting heroes who need to save the universe. And it's these fumbling guys going around the universe trying to save it. And they're at a point where they need to talk to one of the big influential, alien beings out there in the galaxy. And they were stressed out because they wouldn't be able to understand him, and he wasn't going to be able to understand them either. And so one of the guys pulled out this jar, and inside the jar floating around was this little goldfish looking creature that was called the Babelfish. His buddy says, I'm not putting that in my ear. And long story short, he forced the Babelfish into the ear of his friend. And this is what the Babelfish did in fiction, in science fiction in 1987, 88, whenever the movie was made. It would listen to the language and the intent and decipher the intent of what the alien being was saying and translate that into an understandable language for the hero, for the protagonist. And then the vice versa would happen. The protagonist could speak in his British English, and the alien could understand what he was saying and what he was intending to communicate. We're going to have the Babelfish in the next probably 8 years. And it's not going to be a fish, but it's going to be a device similar to the one that I have in my ear right now, whereby you will be possibly in downtown Tokyo looking for directions to, the great sushi place someone told you to try. You're lost. You're going to need to get those directions from someone. You flag down someone who looks helpful. They put their device in your ear. You put your device in your ear. You speak English. They hear them. They hear you in Japanese. They speak Japanese. You hear them in English. A lot of people think we have that already, and it's called Google Translate. But that technology is very imperfect. It doesn't quite grab it. That technology is being rapidly improved to increase translatability, to increase accuracy, and therefore to increase intent. Think about it this way. For years, the diplomats at the United Nations have had those gigantic things on their ears where they're hearing a live person translate into their native language what someone else is saying. You're not going to need the live person with this device in your ear to chat with someone who speaks a different language than you. Really remarkable. It's going to make international travel much more pleasurable. It's going to help us avoid misunderstanding one another. It's going to have a tremendous benefit to society. And so this is the notion of wearable technology. We call it blurring the lines of reality. As an older guy, I'm a little bit skeptical of some of these visual things and virtual reality things, but this is a trend that is very much likely to continue, and it's likely to be a global trend because companies working on this technology are really all around the world. Last story, my son watched down the other night, and again, these are global phenomenons. This is what's happening regardless of what you see on the news with Russia and Ukraine and so on and so forth, and I'll get to that, but these are just remarkable things. My son walked downstairs the other night, and he's got some birthday money. It's $60 in his birthday money. He hands it to me, and I said, "What's this for?" And he says, "Dad, I want to buy the new MLB game for my VR, for his virtual reality thing." And this isn't like the baseball game that I had when I was a kid with the Atari machine. The baseball game I had as a kid was the three outfielders that kind of moved in conjunction with one another, and the ball really never got off the ground. It just kind of floated around, and sometimes it was a single, sometimes it was a home run. It was goofy, but it was baseball nonetheless. My son's Major League Baseball game is actually pretty remarkable. You have to play, you pick a character, you make the avatar, you are the character. You get drafted by a Major League Baseball team. You start off in A baseball, which is the lowest level of professional baseball. And then as you play the game, you get promoted to AA, AAA, and then in the majors. And then once you're in the majors, my son's character has been traded from the Tampa Bay Devil Rays to the Boston Red Sox, now to the New York Mets, right? You get traded, you sign contracts, you negotiate, you do all this crazy stuff that the three Atari guys didn't do back when I was a kid. And so he spent $60 on this. The amount of time he spent on that game, we monitor it because he also spends an equal amount of time, if not more, outside with his friends. We're very happy about that. But the amount of time that he can spend playing this game is unlimited. It's unlimited for $60 versus going to a Colorado Rockies game. Those are long baseball games. They take 3 hours plus or minus. It doesn't cost me $60 to pay for one ticket or maybe 2 tickets I might get on certain baseball games, certain days. But I only get 3 hours worth of entertainment for more money. My entertainment dollar does not go as far if I'm at a baseball game. We're still going to go to baseball games. We're still going to take the pencil and the paper out and score the baseball game. We're still going to do all that. But the digital dollar, the digital entertainment dollar goes a lot longer than the in-person dollar. And you can see this with NBA, Broadway shows, console video games, eating dinner out, video streaming, mobile video games, so on and so forth. We don't want to lose the human connection. I, for one, am trying to really hold on to that, and we'll continue to hold on to that. But the notion is, globally, these things are going to continue. People will spend billions of dollars, $60 at a time, globally, buying video games and playing them with people all over the world. And so that's really some remarkable things that we've seen throughout the world, and innovations that we're likely to see moving forward. And I should pause and say, these things are going to happen. They're going to happen regardless of who wins the midterm election, who wins the next presidential election, what level of inflation is present, what the Federal Reserve is doing with interest rates, or the Bank of China, or the Bank of Japan, or the European Central Bank, what happens with cryptocurrencies, what happens recession, economic expansion, what happens to home prices, what happens to the health of banks. I mean, on and on. These things are going to happen. And the moral of the story being, innovation and human progress cannot be stopped. It can't be stopped. Even in the face of one country, a high-profile way, invading another, like Russia has recently invaded about now, what were we looking at, 6 months ago, invading Ukraine. So let me just take a moment to describe just some goofy reflections that I remember from my time that I was over there years ago. And one of those reflections is there's been a deep-seated element of Russian society. Maybe it's sort of a patriotic pride that Moscow should be a center, if not the center, of global commerce and finance. And back centuries ago, it came from the notion that Moscow should be the center of the Christian world, right? The Christian world center went from Rome to Constantinople, and the third center of the world was supposed to be Moscow. That's what many Russians believe. And our analysts and some of the folks we brought on from outside who've talked to us have said Putin's not a communist necessarily, but he did see the disillusionment of the Soviet Union as something that was very bad for Russia. And so I don't know. We don't know ultimately what he's thinking. If this thing could come to a negotiated end, that would be better. But there are some geopolitical alignments occurring that factor into our analysis as to whether we invest in a company or we don't. Again, understanding not just where they sit, but where they earn. That, possibly he's doing this to reassert Russia's prominence. The other thing is that they've been invaded all throughout their time, all throughout their history, from their western border across. I remember learning that. And so they're very insecure about their western border. They fail to recognize that many times they're the ones that antagonize their western neighbors and their Eastern European neighbors and even their Western European neighbors. But that's where they've been invaded. And so another way to not necessarily explain, but at least know, what Putin might be up to. And the moral of that story is, and I've heard this time and again, is that Ukraine has been described as the breadbasket to the world, which is all the research that I've done and that I've heard about it is not consistent with that notion. Ukraine is one of the breadbaskets of the world, and it is certainly probably a major breadbasket to Eastern Europe. But in food production, Ukraine I don't think they're the top of the world. I've looked at different estimates and a couple of different sources and don't see that. And so that might be an example of our media kind of, maybe reporting things a tad bit out of context or whatever, but it's not going to be without consequences. And that just challenges us as an investment firm to make sure that we understand clearly what the implications are to ASML. And you can see in that graph that they don't earn very much in Russia. Most of their earnings come from the United States and from Eastern Europe, and not necessarily Europe itself, of which Russia is a part of. And so that has led us to understand that a company like that is largely insulated, even though they sit in Northern Europe and are geographically somewhat close to the Russian-Ukraine conflict. It's not necessarily going to have a drastic impact on their ability to transact business or continue to have strong earnings going forward. So this is the kind of analysis that you have to do to understand investing internationally and to understand investing globally that we're going to continue to do every day, all around the world. And so let me stop there. Hopefully that was helpful, and hopefully it was at least somewhat enlightening to everyone on the call. I appreciate you taking the time, and Carl, I'll kick it back to you. Mindful of the time and the moral of the story, you can't stop human progress, and it makes sense to have some investments overseas. Absolutely.
Roger, thank you so much. That was great. I love your optimism. I share it. And I think that your future looking slides there really make it real. I mean, these are things that we have seen evidence of growth in the past, and that seems like it's likely to continue. And certainly the opportunities outside the U.S., there's just a lot more people outside the U.S. than inside the U.S. I've got 2 or 3 questions that some folks asked beforehand. If anybody has any questions now, please type them in, and we'll go ahead and fire away. So please just use that chat menu, bottom of your screen, just type in any questions you might have. But the first one is, Roger, is it advantageous to diversify overseas? Yes,
it really is. How you do it is another question, but yes, it is advantageous to diversify overseas. Not to get too technical, but there's a sweet spot. There's a sweet spot in terms of a portion of a portfolio invested outside of the United States, with companies domiciled outside of the United States that add an optimal amount of return without increasing necessarily the amount of risk or even decreasing the amount of risk. And that's a moving target. That's very much a moving target, because the world is not a static place. As we showed you with thinking about what's going to happen in 2030, things change, and the world has become very much more connected. And so that percentage is kind of a moving target, which leads us to believe that there is a role, distinct and important role, for a financial advisor to match that target with whatever the risk and return is that the investor should consider.
A great answer. Thank you so much. I think I completely concur with you there. Hey, should investors overweight? This is a more tricky one. Should investors overweight stocks with attributes associated with higher expected returns? In other words, if we expect better returns from a certain asset class, should we put more money in there?
Possibly. It depends on who you are and what you need your money to do and when you need it to do it. Because as I had mentioned earlier, on that sweet spot of how much you should have invested overseas, really, there's a couple of different things to consider. One is return, and that's great to say, hey, higher expected rate of return, that's excellent. But the next question is, how much risk goes along with that? Generally speaking, the higher the return or the higher the yield that comes off of a security, like a bond, like a high yield bond, the higher the risk associated with that. And so again, that's putting it on that, that weighing machine, the balance of, do we have the appropriate amount of risk and the appropriate amount of return? And so it's important. Yeah, it's great to say higher rate of return, put more of your money in that. That is advantageous, but make sure that you're not throwing the risk off, because as an investment can go up more, it can also go down more. And again, if you're the kind of person that's getting set to go from earning the paycheck to creating the paycheck, return might not necessarily be as important, given the fact that you've already created some wealth, as making sure you take on appropriate amounts of risk And back to that notion earlier of taking an appropriate amount of dividends. The vast majority of dividend yielding companies at 3% and higher dividend yields being outside the United States. So, higher expected returns are great, but just make sure that you're not assuming risk that you don't know about or haven't factored in.
Great. Thank you so much. And it's really interesting to think about that the higher yielding investments are largely outside the U.S. And sometimes we don't even give that any careful thought. I've got another one here. Is there a chance you could earn better returns shifting to international investments due to the current inflation, economy, and other stuff going on in the USA today?
Yeah, there is a chance. Yeah, there is a chance. International investments in large, as I had mentioned earlier, for the better part of 20, certainly the last 10 years, the U.S. stock market has outperformed the rest of the world, which, for the benefit of everyone on the call, the business that Carl and I and Stacy are in is cyclical. It is cyclical because it moves in cycles. And which does better, the international to the U.S. is also a cyclical thing. And so you can make the case that since the U.S. stocks have done better, maybe now it's time for the U.S. stocks to not do as well over the coming 10 years. And so that can certainly be part of it, but there has to be a tangible reason for that to happen. Inflation in the U.S. is actually probably being dealt with more aggressively. We were late. Our Federal Reserve was a bit late dealing with inflation, and that's why bonds have done so crazy this year, but still ahead of Europe. And that seems to be kind of the case. Last 20 or so years, the U.S. has kind of taken their punches and tried to get out in front and dealing with some of the adverse economic things like inflation or the great financial crisis, the global financial crisis in 2008, the Great Recession, those kinds of things, than our international friends. And so, right now the U.S. is ahead of the game, so it's possible that the U.S. will keep going in terms of leading. But this year it could be a transition year because international and U.S. stocks are kind of doing the same thing. We'll see what happens with inflation. If it gets under control in the U.S., that's going to be good for the U.S. relative to outside the United States. But if the opposite is true, that's going to be good for the international markets. The moral of that story, there is no such thing as a future fact. Have them both and be flexible is the notion there.
Great advice. So yes, there's a chance, but it's better to be diverse than to bet your house on anything. I've got a question here from one of our speakers or one of our guests. Roger, would you invest differently for people in their 60s than those people in their 80s?
Absolutely. Absolutely. I'm going to give you an example. We're gonna take 10 years off of both of those, but the notion that I'll give you and the story I'll tell you applies. I'm a 50-year-old man and just turned 50 last year, which is crazy. My father is 75 years old, which is even crazier. But my dad has a portfolio of about 10 different mutual funds, all American funds, and I have a portfolio of 11 different mutual funds, all American funds, and in common we have one. He has 9 funds I don't have. I have 10 funds he does not have. And the reason for that is, like I'd mentioned this earlier, he's already spent his life amassing wealth. He's got a degree of wealth, as does his wife, and we've cobbled together a secure retirement for him. But he needs to be more aware of making sure that his investments don't go down as much in value, which is happening right now. It's happening. His investments are down much less than mine, but I have more time and I'm buying. So I'm going to be buying lower and lower. Whereas what he's focused on is preserving his wealth more and getting a higher income. He gets a lot more in income off of his portfolio from both the stocks and the bonds that I do. So whereas I am still accumulation minded, he is more preservation and income minded, which means the investments that generate preservation and income are different than the investments that generate accumulation. And so, that accumulate wealth. And so he's got less risk, more income. I have more risk, less income because I'm continuing to invest, but he needs to rely on it. So the answer is absolutely yes. It just kind of depends on what you need. How much of the money do you need? How much of the money can be passed along to your heirs? Because that determines the timeline for the money. And it could be that an 80-year-old person's money Maybe they can live off of 3/4 of their wealth, and 1/4 of their wealth is investments that could be passed along to kids and grandkids, which makes the timeline for that money much longer, which means, okay, that's more accumulation focused as opposed to the 3/4 of the wealth that is more preservation and income focused. So it's really a balancing act between those two things: preservation, income, and accumulation. So yes, that's a long answer, Roseanne, to your question, but the short answer is yes. Yes. Yeah, I would.
Yeah, thank you, Roger. Yes, and it depends. Great. Well said. Well said. Well, thank you so much. If you have any questions, anybody, please fire them in right now. I'm going to share my screen one more time. We do events like this every month. Roger, thank you so much. You were great. We really appreciate your insights and the optimism and your sound advice. Anybody on the call, please contact your financial advisor for advice and talk to them about your unique situation. That's the best way to learn more about international investing, how much you have in your portfolio already, and whether you might want more or less, or wherever your situation might entail. Follow us on Facebook. Check us out on LinkedIn. Like our YouTube channel. We have a podcast called the Expert Network Team. Please subscribe to that. You can listen to it anywhere you are, in the car, or on your iPhone or your Android phone, or on the car. On our website, we have an archive of everything. So that's why we're recording this. You'll see this hopefully within a week on our website. I think the recording came out well. As far as I can tell, there's no technical difficulties, so we should be able to have this up real soon. And then you'll see all of our previous lunch and learns on the website as well. Our blog posts come out every week. You can check that out. And if you're not already subscribed to our email newsletter, the Periscope is very popular. This week's Periscope, I've heard more positive comments about that than before. It has all the content I just mentioned, plus some others just for subscribers only, particularly in light of the stock market and its recent manic behavior. You might want to make sure that your advisor is sending you that every single week. Without further ado, I'm going to let you go. Thank you, everybody, for joining us. Again, Carl Frank, Roger Bianco, great job. Thank you so much for being a part of it. And everybody, create a beautiful day.
You bet. Thanks, Carl. Stacey, I hope it was helpful for everyone. Take care. Have a good night.